Hi, this is Bruce at Turnaround Stock Investing. Today we're going to be discussing Teekay Tankers. But before we do so, I just want to read my disclaimer that Turnaround Stock Investing is not an investment advisor. This content is for educational purposes. Please see our disclaimer at the website Turnaround Stock Investing. Today we're going to be discussing Teekay Tankers. I estimate this video will take 15 to 20 minutes, but you will come away with an in-depth knowledge of the tanker industry, where we are in the cycle, and what the opportunity is for Teekay Tankers share price over the next year or two. Right now, I think at its current share price of $1.60, Teekay Tankers is a potential five-bagger. I state this because I believe right now we are at peak pessimism for tanker rates. During this cycle, rates are at lows that have not been seen in the last 3 or 4 years. The other interesting thing is that tanker scrapping is increasing just as new build deliveries are declining, and this in the future is very positive for rates. This video is going to go over the demand for oil tankers. We're going to review Teekay Tankers' balance sheet and cash flows, and we're going to take a look at the technicals of the stock chart along with other tanker stocks to show that I believe we are right now at a very good bottom. Before we go into the supply and demand for the overall tanker market, let's examine what the fleet looks like for Teekay Tankers. This is what it looks like pro forma as of June 30th, 2017, after their contemplated merger with another company. We'll be going through that merger in detail in the following video. However, right now what we want to know is there's going to be 30 Suezmax vessels, 22 Aframax tankers, and 9 LR2, and 1 VLCC. So keep that in mind as we go through the overall supply and demand balance within the tanker market. The first thing we want to examine when we look at the supply and demand for tankers is what is the supply of oil. And as we can see in this chart right here, from 2012 to the current levels, we are now producing 96 million barrels around there per day, up from 88 million barrels a day. Not many people are aware of it, but the demand for crude oil has been increasing about 1 million barrels a day since 1990. This is a great chart to illustrate this. The only time since 1990 when the demand for oil did not go up was in 2008 and 2009 during the Great Contraction. But otherwise, you can see we've got some steady, consistent growth here. In this chart, Euronav, which is another oil tanker company, is trying to show that if there's a 1.4 million barrel per day increase in the demand for crude, you're going to have a necessity for more crude tankers. In this case, it's trying to show if the crude were to come from the Americas and to China, you're going to need 57 VLCCs. And in here, you can see the calculation. If the oil is coming from the Middle East, you're going to need 28 VLCCs. The importance of this slide is just to show that there is an increasing demand for vessels each year with the natural growth in demand. Let's now take a look at the amount of vessels that are on the water. Right here we can see what the VLCC fleet is, Suezmax and Aframax. We're primarily not concerned with VLCCs as TK only has one VLCC tanker. We're more concerned with Suezmax and Aframax. Right now, the Suezmax fleet totals about 500 vessels, and the Aframax fleet totals about 975. We can see right here that the percentage of the fleet on order for the Suezmaxes is 12% of the existing fleet, and that would come through the remaining of 2017, 2018, and 2019. And for the Aframax, 13% of the existing fleet is on order right here between 17, 18, and 19. Now, what's happened over the past few years is that you've had many more deliveries and not a lot of scrapping, which you see here. But for the first time, starting in 2018, you are going to begin to see fleets decrease as scrapping accelerates. And we're going to go into more detail, but I just wanted to give you this picture here so you can get an overall view of how large the fleets are compared to what potential scrappings can be. We're going to take a look at the next slide, which will go into more detail. In this particular slide, we can see a little more detail as to what the order book looks like. And as you can see in the previous years, the amount of scrapping that has occurred relative to deliveries has been very small. But coming into 17, 18, and 19, we're actually going to potentially see more scrapping than deliveries. And small changes in supply and demand in the tanker market can have very large effects. This is why I'm becoming very bullish that the tanker market, that spot rates are going to start increasing. Now, nobody sees that currently, and the pessimism is extremely high. But in the tanker market, you typically have to buy your shares 6 months before anybody else can see it. But logic suggests to us through supply and demand that this is going to be occurring, that supply and demand is going to tighten quickly. We can see a similar development in the Aframax market right here, Aframax LR2 combined, where you can see that starting in 18 and accelerating into 19, scrappings are going to pick up and outpace deliveries. This again is very bullish. Now it looks like scrappings will increase dramatically more in 19 than in 18, but Aframax growth has not been that large in these last few years. As you can see here in 17, fleet scrapping versus growth has been not that pronounced. Next, I want to give you an idea of the volatility of spot tanker rates. This chart goes back to the year 2000. Here is the spot rate per day. And as you can see, prices range from $40 to $60 to $70,000 a day, all the way down to 10. In 2012, from the bottom, we went from about 12 up to 40,000. This occurred as the supply and demand came into equilibrium. Right now, rates for Suezmaxes, as we speak, are probably $6,000 to $8,000 a day. And this is the reason that TK's price is $1.60. There's extreme pessimism. However, as the supply and demand for tankers comes into balance, you will see rates adjust very quickly, and I expect that rates for Suezmax and Aframax will rise to 30,000 over the next year or two. Now we're going to start to dive into TK's financial statements. Right now, we're looking at a pro forma balance sheet for Teekay Tankers after the merger with Tanker Investments. And as you can see right here, the company will have about $2 billion in vessels, that's what it's valued at on the books, versus $1 billion in long-term debt, say $1.2 billion, against $1 billion in equity. The balance sheet doesn't appear to be very bad. To get into a little more detail about the balance sheet, I'm showing you now my projections for the fair market value of the fleet. So right here, we've got TK's fleet before the merger. Here's the Suezmaxes, the Aframaxes, and the LR2s. And I came up with a range of values based on the age. And right here is the values for the TIL fleet. So what you can see here, including miscellaneous vessels, is that we've got $1.77 billion in total asset value. The total debt of the combined company is about $1.16 billion, and the net asset value is $615 million. With 269 million shares outstanding, you're looking at a net asset value of $229, which is substantially above our $1.60. Now, valuing tankers, these values can go up and down to $3 million for each vessel, but I think this is a good approximate range of what the values are currently. So this is just further back up to the balance sheet that you're looking at right now in relation to equity to debt. Book, I think at this point is probably $5 a share pro forma. However, this amount of debt is not good when a company is generating very little cash flows. And that's the reason that Teekay Tankers is $1.60 a share. So now we're going to take you through the cash flows to see if TK can survive with present spot rates. You're now looking at a pro forma spreadsheet that I created to determine what the cash flows will be in the third quarter for TK given different rate scenarios. TK will not be merging with TIL till probably the fourth quarter, late fourth quarter. So this is representative of what the cash flows will look like over the next few months, or what will be reported. The goal is to see, can TK survive with rates at their current levels? Now, these are the revenue days that are generated based on the fleet that TK has right now. These are the vessels that are out on charter, and they're earning pretty good rates. These are the vessels that are in the spot market. And of course, what I did here was I have rates at these various scenarios. I'm projecting that in the third quarter, this is probably the level that TK is receiving for spot rates, anywhere between 12, could be a little higher. So let's take a look at what that means for the cash flows. At this scenario 2, we're looking at TK generating $62 million in revenue. After cash operating costs, you're going to have, which have totaled about $37 million, you're going to generate EBITDA of about $21 million. After that, we're going to have $8 million of interest expense and $1 million, I estimate, in dry docking expense. The problem next is term debt payments. TK has $25 million a quarter in debt payments that it has to make. And this is the prime concern that investors have right now. Will they be able to amortize their debt given this small EBITDA, given the low rates? So in this particular scenario, it's highly likely that TK will go through $13 million in cash next quarter. That's quite a bit of money. Let's take a look at that in comparison to what their cash availability is. They're starting the quarter, I estimate, with $87 million in cash. They'll burn through 13, which means they have $73 million in cash and an undrawn revolver of $35 million, which gives them total availability of $108 million. So as you can see, TK does not have many quarters available to them to operate with these types of levels of spot rates. However, my opinion is that these rates are not going to be around for many more quarters, and that if this is the bottom, we are going to start to see large potential increases in cash flow as rates increase. And so let's take a look at the next Proforma spreadsheet where I can show you what the volatility in cash flows can be as rates increase. You're now looking at a Proforma cash flow statement that I created to reflect all of the tankers that will be available to TK after the merger. So if we go to the bottom here, this cash flow statement assumes that we're going to have 30 Suezmax vessels, 24 Aframax vessels, 7 LR2s, 1 VLCC, and 5 vessels for their operating segment, the STS support. So let's take a look at what this means. Right off the start, we're going to see I have zero amount of vessels in the chartered out. This is highly unlikely to occur as the company historically likes to charter out 30% of its vessels at any one time. But just to show you the operating cash flow volatility that can occur with higher rates, I wanted to put everything into the spot market. So assuming that all the vessels are operating in the spot market, what happens if TK were to generate rates of $40,000 a day for Suezmax and Aframax and $25,000 a day for LR2? Well, in that case, you're going to generate $852 million in revenue, spot revenue, right? You have VLCCs already out on charter, which brings in $13 million. Then that is going to bring us $643 million in EBITDA. Just so you can understand what that means, in scenario 1 with present rates, the same EBITDA is $58 million. The swing is absolutely incredible. The leverage is stupendous as rates increase. With that $643 million in EBITDA, we have the ability to pay $48 million in interest, $12 million in dry dock expenses, and amortize debt to the tune of $140 million, which is what occurs or is required on an annual basis. That could potentially give us a free cash flow of $440 million after amortization and interest. Just so you can understand how much that is, the company, with its current situation at $12,000 a day, after required debt payments of $140 million, will have a negative cash flow of $144 million. Now, this is the reason that TK is trading at its present level. The company would not be able to sustain operating at these types of spot rates because $144 million in negative cash flow would drop their cash balances to negative. So what would be likely to occur is that if spot rates stayed at these levels for 6 months, TK would probably require a debt amortization holiday from its banks and have to raise equity. I don't think TK would go into Chapter 11, but there would be more dilution. But in my opinion, spot rates are going to rise, and we're probably witnessing the cyclical lows in rates. Let's assume now that I'm correct and that rates do go back to $40,000 a day. Well, what does that mean? Let's compare that to what we're paying for the business right now. Currently, the share price is $1.60. After the merger, there'll be 269 million shares outstanding. That will give us an equity capitalization of $430 million. There will be net debt of $161 million, I'm estimating. That could go down because the company's in the process of doing a sale leaseback, but let's just keep it at that for the moment. If we assume that rates were to go back to $40,000 a day and the company were to generate $643 million EBITDA, I think it's possible that the market would assign it a multiple of 5 times EBITDA. Remember, at peaks, people can get excited and they think it will continue for a long period of time. So I think that's possible. That would give us a market capitalization of $3.2 billion. Assuming the debt outstanding will drop to $700 million from $1.16 billion, because obviously the company would be paying down debt, would give us an enterprise value of $2.5 billion. If the shares outstanding stay at 270 million, you're looking at a next peak cycle price of $9.36 a share. The stock is currently $1.60. This is where you get your 5-bagger. So as you can see with TK, we have high risk given what potentially can occur if rates stay at current levels versus high reward. So we have to determine what are the probabilities that this is going to occur. I actually think there's a 50% chance, even higher, that rates will go back up to this level. I also believe that on an annualized basis, it's highly likely that rates are going to stay in the $20,000 range. And what that means is that TK basically can service and amortize its $140 million in debt and generate a $33 million in free cash flow. So I think that this is a very good, what I call option stock. It's not going to go bankrupt in the worst case scenarios. Again, given that I think that this is what the annualized cash flows will be. However, if I'm wrong and rates do go lower, then you are looking at a case where TK will probably have to issue equity and do a debt amortization holiday. In that case, the share price will probably fall down to $1. So now let's take a look at the technicals, because I will never buy a stock unless the fundamentals and the technicals line up. We're now looking at a very long-term chart of TK going back to 2008. And as you can see, this stock was up in the 10 area and went down to 2 at cyclical lows here, the last cycle low, spiked up to 7, and actually has broken this base at $2 a share, or say $1.80, and recently went down to $1.40. So it has broken this long-term base, which is indeed bearish. But let's take a look at where we are now in relation to this base. We're now looking at a 2-year chart for TK, and something significant has happened. You're right here looking from 2016, when the stock was about $4 a share. It has been in this consistent downtrend, and the stock has never went above this downtrend line. But recently, since September, it has. So basically, it has changed trend. The other significant thing to notice here is that when stocks are in downtrends and they sort of make a reversal, they very rarely will rise above the previous lows. And in this case, this level of $1.60, $1.70 is very significant. As TK travels up and beyond $1.75, I think confirmation of a bottom is extremely high, because this is very difficult for stocks to do, to break above what's known as resistance. This is a shorter term chart. Another point I want to make is that Stocks that are in downturns rarely rise above their moving averages. In this case, I track a 50-day moving average against the stock price. And as you can see, the stock price never really rises above this 50-day moving average. But now it has. So this is a very significant movement. And especially you want to see the stock rise above a moving average that is sort of flattening out. So this is just another hint that we are maybe at a significant bottom. The final piece of evidence that will confirm that a bottom is in place is once we rise above this trend line here, this bottoming formation that existed when the stock was always, let's say, I think in this case, around $1.80-ish or so. It takes an enormous amount of demand and interest for a stock to rise above this significant level of resistance. And I do believe that this is going to occur, that the tanker market is indeed turning and the market is sniffing this out. So I expect that over the next few months or so, TK is going to rise above this level. Now, of course, I'm just a mere mortal and I don't know for sure. So the way that I am playing this is that I am currently buying shares of Teekay Tankers. And I've started buying over the last few weeks. Now, whether you will join me or not is up to you. But I would say for those of you that are looking for confirmation of a bottom, your best time to buy is when this stock breaks $1.80. To me, that will be confirmation that we have seen the lows. I personally am going to stop out of this position if the stock breaks $1.55. If we reverse and start to break this level right about here, I will set a stop on my stock and sell it and just watch and revisit later on and see how things adjust. Another piece of evidence that I want to present before I finish out this video is that it's always important to look at what the other stocks are doing in an industry. And right now you're looking at the stock of Frontline, which is one of the other large tanker companies. Now, I believe TK is a better purchase than Frontline, but it's important to look at what's happening here. And Frontline is also confirming that a significant bottom has been reached. We can see here in this long-term chart that the stock last reached these levels of around $5 a share in late 2014, came back to test those lows, and is now starting to break out. You can see that the stock is starting to rise above these previous levels of resistance. There was resistance here and it rose above it, and it's now even starting to rise above this moving average. Let's take a closer look. This is a monthly chart for Frontline with a 10-month moving average. And what you can see is that this stock since 16 has not really risen above the moving average, but it finally has right about here. So the short term is sort of confirmed by the long term. This is a significant event right here. Now, of course, there's tremendous uncertainty in the tanker business. So people don't know whether they're coming or going. That's why you look at the charts. Let's take a look at a few more tanker stocks. Here's Euronav. In fact, we used some of their charts earlier in this presentation. And as you can see, this stock has broken out. Broke this downward trend line in early 2017, and the stock has been meandering around here, tried to go back to the old lows, but now has broken this old resistance, and the stock is now, as of this week, over 850. This is a more confirmation that the tanker market has probably bottomed. Let's take a look at another stock. Here's Generate Maritime. Again, this long-term downward line, broken. The stock moves sideways, comes back to test this old low, and is now starting to rise above this previous levels of resistance. Again, confirmation that we could be at a significant bottom for tanker stocks. So the video ran a little longer than I thought at 23 minutes, but I hope that I've presented a clear case for TK Tankers and why it may be bottoming. If this fits your risk tolerance, this is probably a good stock to consider. If you have additional questions or want a copy of my spreadsheet, just reach out to me on the forum at Turnaround Stock Investing. If you're not a member of Turnaround Stock Investing, consider joining so you can get a copy of this spreadsheet and ask questions about this company or any other company that we cover.